1 year ago, Netflix was the undisputed king of streaming, trading at all-time highs. Today, the stock is down more than 40%. And here's the twist: this spring, Netflix walked away from the biggest media deal in history and collected $2.8 billion just for leaving the table. So is this a broken growth story, or a once-in-a-decade entry point? In the next 10 minutes, how Netflix really makes money, the true numbers, and the 2 risks that could change everything. Subscribe if you find this useful. Now let's get into it. The story starts in 1997, in a small California town called Scotts Valley. Reed Hastings and Mark Randolph had a simple idea: rent DVDs by mail, with no late fees. Legend says Hastings was inspired by a $40 late fee on Apollo 13. The truth is messier, but the insight was real. People hated late fees, and the internet could fix that. Netflix launched with just 925 titles. In 2000, with the dot-com crash draining their cash, the founders flew to Dallas and offered to sell Netflix to Blockbuster for $50 million. Blockbuster's executives nearly laughed them out of the room. 10 years later, Blockbuster was bankrupt. Netflix went public in 2002 at $15 a share, and in 2007 made the bet that changed everything: streaming video over the internet, back when most homes barely had the bandwidth for it. Then Netflix did something no tech company had dared: it became a studio. House of Cards in 2013 proved originals could win Emmys and subscribers. In January 2016, Netflix switched on in 130 new countries overnight. But 2022 brought the crisis, the first subscriber loss in more than a decade, and a 75% crash in the stock. The response? Cracking down on password sharing and launching ads. It worked. The business model is beautifully simple. More than 325 million households pay Netflix every single month, in over 190 countries. That is predictable, recurring revenue most companies can only dream of. And since 2022 there's a second engine: advertising. The cheaper ad-supported plan brings in price-sensitive viewers, then sells their attention to brands. In 2025, ad revenue passed $1.5 billion, more than 2.5 times the year before. Think about the scale. 325 million paying households likely means over 700 million people watching. In the first quarter of 2026 alone, Netflix aired more than 70 live events, including the World Baseball Classic in Japan. It is no longer just a video library, it is becoming the world's biggest television network, with live programming attached. Feeding that network takes staggering amounts of content. In 2026, Netflix plans to spend about $20 billion on programming, up 10% from last year, and more than most Hollywood studios combined. That budget built Squid Game, Wednesday, and K-pop Demon Hunters, one of the most watched animated films ever. The strategy is brutal and simple: outspend everyone, in every language, in every genre. Now the numbers. In 2025, revenue grew 16% to $45.2 billion. Operating margin hit 29.5%, up from 26.7% the year before. For 2026, management is guiding to roughly $51 billion in revenue and a 31.5% operating margin. Read that again: a company this size, still growing double digits, while expanding margins. So why is the stock down 40%? The first quarter of 2026 explains it. Revenue rose 16% to $12.25 billion. Operating income grew 18%. Earnings per share came in at $1.23, though that includes a one-time $2.8 billion windfall we'll get to in a moment. The problem? Guidance. Netflix projected only 13% growth for the second quarter, and Wall Street heard one word: deceleration. The stock fell almost 8% overnight. Here's where it gets cinematic. In late 2025, Netflix agreed to buy Warner Bros. Studios and HBO Max for roughly $83 billion. Harry Potter, DC, HBO, all of it would have belonged to Netflix. It was the boldest move in company history, and it would have redrawn the entire map of Hollywood. Then Paramount Skydance crashed the party with a $111 billion bid for all of Warner Bros. Discovery. Netflix had 4 business days to raise its offer. Instead, it walked and collected a $2.8 billion breakup fee on the way out. The market read it 2 ways. Discipline, refusing to overpay in a bidding war. Or retreat, losing the biggest content prize in a generation. Either way, Netflix keeps the cash. Where does that leave the stock? After the 10-for-1 split in late 2025, shares trade near $77, more than 40% below their all-time high of about $134. Market value, roughly $330 billion. The price-to-earnings ratio sits around 25. For context, that is one of the cheapest multiples Netflix has traded at in years, and close to the average stock in the S&P 500. So why so cheap? Reason 1, the law of large numbers. Growth of 16% is slowing toward 13%, and management's own guidance confirms it. With over 325 million households already subscribed, the easy growth is gone. Markets do not just price what a company earns today, they price the direction of travel. And the direction, for now, is slower. Reason 2 is the risk that keeps executives up at night, the attention war. Younger viewers are drifting to YouTube, TikTok, and short-form video. Some analysts warn that short-form is doing to streaming exactly what streaming did to cable television. Netflix still commands under 10% of total TV time, which is either massive upside, or evidence that even the king of streaming is just one player in a crowded fight for eyeballs. And there is a second risk, the money machine itself. If cheap ad-supported plans cannibalize premium subscriptions, margins suffer. If the ad market slows, that 31.5% margin target gets harder to hit. Meanwhile, Disney, Amazon, and Apple keep spending billions on content, and sports rights keep inflating. Netflix has to keep winning every single night, in every market, against rivals with nearly infinite balance sheets. There is also a symbolic change. Reed Hastings, the co-founder who built Netflix from a DVD website into a global empire, is stepping away from the board as his term expires in June 2026. The company now fully belongs to co-CEOs Ted Sarandos and Greg Peters. The vision that created this industry is officially passing the torch. So what could turn the stock around? July 16th, second quarter earnings, where Netflix needs to beat its own cautious guidance. Then comes the strongest content slate in years, Greta Gerwig's Narnia, David Fincher's next film, a new Stranger Things spin-off, and more live boxing. Every hit show is now also an advertising product. One blockbuster quarter could reset the entire narrative. The long game is bigger. Advertising could grow from $1.5 billion into a multi-billion-dollar pillar. Live sports and events give Netflix pricing power that cable networks would kill for. Gaming is still an experiment, but a cheap one. If margins keep climbing past 31.5% while revenue compounds at double digits, today's $330 billion valuation may look very different in 5 years. So, value trap or opportunity? The bear case, growth keeps sliding, attention keeps shifting, and 25 times earnings is simply fair for a maturing company. The bull case, this is the same stock that crashed 75% in 2022, then quadrupled. A dominant platform, expanding margins, and a multiple near the market average. History says betting against Netflix has been expensive. It also says the road is never smooth. If you want exposure, Netflix trades on the Nasdaq under the ticker NFLX. Most brokers offer fractional shares, so you can start small. Many investors use dollar-cost averaging instead of trying to time the bottom. Prefer the indirect route? Netflix is a top holding in S&P 500 index funds and communication sector ETFs like XLC. Whatever you choose, position sizing matters more than perfect timing. So here is Netflix in 3 numbers: $45 billion in revenue, 325 million households, and a stock down more than 40% while profits hit records. That gap between the business and the price, that is where every great investing debate lives. This video is for education, not financial advice. Always do your own research. If you learned something, subscribe and drop a comment. Which company should we break down next?